Let's talk money.
I don't have your money.
I know I'd be a lot happier with some extra cash.
Is this about money?
Obviously, this is all about money.
Oh, man, we got bills to pay, buddy.
With practical tips and a focus on Scripture, let's talk money. With Dave and Reb. From More Than Enough. Real conversations about money for real people. Let's talk money.
Are you ready to talk money, Reb?
I am ready to talk money.
You are looking mighty shiny today.
Well, I am orange. It's orange and black season, I guess.
Yes.
Yeah.
So this is my segue into, if you're listening for the first time and you're on a podcast, we're on YouTube too. And we were just discussing, it's been about a year.
I think so. I think a year we've been on YouTube, yeah.
So, man, you know, if I know that you love your podcast, but sometimes you just need to see our lovely face. So today is a good day to check out Reb because she's wearing a nice, beautiful fall
colors. Yeah.
Mm-hmm. So good.
Yes.
And of course, if you are listening and you're like, where do I hear more? How do I search? We were just having a conversation about AI. You can ask AI how to find Let's Talk Money with Dave and Reb. And it will tell you. It will tell you where to go and all the places where you can find this podcast and all that. And we have a special guest. But before we get to the special guest, we have a special sponsor for today's show. It's you.
It's me. Let's talk. No, it's sorry. More Than Enough Financial.
Rebs doesn't really
know who I am. Yeah, yes. Okay.
Yeah. So thank you, Reb, for sponsoring today's show.
Well, it's More Than Enough. The mortgage, tax, and coaching and equipping company.
So if you've never visited the More Than Enough website, morethanenough.ca, check it. There's tons of content there. There's all kinds of, you can get written content. You can listen to this podcast. There's
our financial fitness seminar is on there, which we highly recommend. It's on video.
And so there's just lots of things to peruse. Again, I know how we all love to spend time on websites going through, but you'll have some fun, and of course you'll get to see Reb and I if you find us and you do. So on with the show, we have a very special guest in Tim Jenkins, and usually, like sometimes I introduce and I give the nice bio, but for Tim, I'm going to let you do that, Tim. So I want you just to tell us who you are, tell our listeners who you are. And then we've got some exciting things to talk about today. I'm excited about today's show because I love this topic. So we're going to keep you in suspense. And Tim, tell us who you are.
Yeah, so Tim Jenkins, and I lead a team at Trinity Family Wealth Advisors, and we serve clients across Canada and into the States, mostly in Canada though. It's exclusive to high net worth families, but today's topic is kind of for any kind of economic spectrum. But we work with high net worth families, helping them determine how much is enough, how much is enough for their kids, helping them develop their estate plan, their financial plans, helping them look at generosity and how would they enhance that, and how do they involve their kids in generosity, and what kind of things does that can that do for their family and their relationships. So we do business transition work as well. So really holistic in our approach, focusing uniquely on that particular segment of the market.
Nice.
Great. Well, thanks for being here because we're going to talk about CRA. So everyone who is afraid of CRA, just listen because some of the mystery and fear can be dissipated by listening to the show today and planning ahead. But I wanted to read a couple of scriptures that, again, aren't directly have money to do with them. But I was thinking about the verse in Proverbs 16, verse 3 that says, commit your way to the Lord and your plans will be established. There are some verses in the book of Proverbs that really talk about we have our plan, we commit it to the Lord, and He has the final say. And then I was thinking about the verses in Psalm 37, which you may wonder, what does this have to do with anything? But it reminded me of that word commit. When you commit your plans, so even the things you're going to hear us talk about this week, and we have Tim back next week, when we commit our plans to the Lord, the word actually means to roll off onto. So we're rolling off, especially in this season when we may not understand things. We may not understand what's happening in the markets or in the world with the struggles and I don't even have to mention the details. We all know what's happening. But when we commit our way, we're actually, I think about all these burdens on my back, and I'm literally taking them and rolling them up into a carpet, so to speak, and just rolling them off onto the Lord. I'm going to give this to the Lord. So I'm going to hear wise counsel this morning from Tim and in our discussion. But as I listen, I'm also going to be committing these things that I'm learning to God and able just to give them to Him. And I visually think of it as a rolling off. Like, let's roll this off. And God is going to help us because that's His word. So we often think, there's so much trouble in the world, in our land, and we think, does God care about my bank account? Does God care about my legacy, or what we're going to talk today about our estate and what happens when we die tax-wise? Like, does God care? And I say He's such an intimate Father that He does, that we can commit. It says in Psalm 37, trust in the Lord and do good, dwell in the land and feed on His faithfulness. I imagine myself as a little girl eating strawberries in that strawberry patch. And I think of God, just His faithfulness, that patch of faithfulness that I can just sit and feed off of. We can delight ourselves in the Lord. He'll give us the desires of our heart. And then it says, commit your way to the Lord. Roll off our way to the Lord and trust also in Him, and He shall bring it to pass. So, while we introduce this topic, and Tim's going to speak to it, because I read your blog and in the show notes today, I'm going to have the link to the blog that you can read as well if you learn, not so much by auditory learning, but we're going to have that information in the show notes today. But I read your blog, and it was titled this, How to Eliminate CRA from Your Estate. So I want to know, like, Tim, let's just...
Okay, you have to say that again. I'm going to interrupt because this is yes, you heard right. Yes, you heard right. So say that again, Reb.
How to eliminate CRA from your estate. Now, of course, that is who would want to read that article?
That's like saying,
So tell us about that. Why did you write that, and why are we talking about this today?
Yeah, so, after 30 years in the financial industry, life comes down to about 5 key questions. And I think one of the biggest ones that nobody asks. If myself and my spouse were to pass away yesterday in an accident, how much will Canadian Revenue Agency, or CRA, get from our estate? That is a massive question. It needs to be asked. For most people, they need a tax preparer to run the numbers for them on that. It's not really complicated for them to do that or take them very long. But I want to know that answer. And I have never met somebody before I met them that knew the answer. That's one of the things that we do for clients. Yeah.
I put my hand up.
Yeah.
What's funny is I did some work with a foundation about 10 years ago or so, but that was kind of revelatory for me. We had
no idea.
Nobody does.
No idea.
Nobody does.
That was one of the things. The question was, okay, so how do we minimize the tax, on estate planning? And I was like, nobody likes to think or discuss estate planning. And Reb and I, and you've heard another podcast where we talk about our drop dead binder, and I won't talk about that, but that's some of those things began to get us talking about what is the end of life, and what is our legacy, and what is the estate.
Yeah.
And of course, then it's like, okay, what are the tax implications of that? So go for it.
Yeah. So the reason that I wrote the blog was it's such an important question, and you need to know the answer. But the other side of it is most people, as you guys have acknowledged, don't even know CRA has their hand out and the lawyer's going to cut a check to them. Mm-hmm. That's for most clients, or most of the population. We'll talk about where it applies. But that is the fact, and people are just not aware of that. So where does the issue come from? Basically, here's what happens when people pass. I'm going to use a couple as an example.
Sure.
But it could be an individual. It's going to work the same way. You can follow through. So there are assets that when we pass become taxable. Mm-hmm. So let's start with the ones that aren't taxable. So life insurance probably is not going to be taxable. Our tax-free savings account is not going to be taxable. And growth on our principal residence won't be taxable.
Okay.
But you may have other assets, and anything beyond that is going to be taxable when we pass. So let's talk about how that works. We've got the couple example. Let's use a couple that has RSPs, or they're beyond 72 and they've converted those RSPs to a RIF. So a registered retirement savings plan, an RSP, or a RIF, it just converts when you're 72 and we have to now draw some income. So what happens is typically on the first death of a couple, all those assets roll to the second spouse, and they roll tax-free by and large. Not an issue. But now where we had assets in two different people's names, now they're all in one person's name, so one person has a lot more assets. Now here's what happens when that second spouse passes. The way CRA works, they say all of the value of those assets got sold the day that you passed, and that becomes taxable. So in Canada, we have a graduated tax system. So think of it as stair steps. The more income we have, we hit these new steps on the stairs, and the percent that goes to CRA increases. So let's just pick a number here. Let's say that in your RSP accounts or your RIFs accounts, between both spouses, you've got $300,000. That's not uncommon. Could have more than that. If you're in your 70s, you've accumulated, could easily have 2-3 times that. But if you're younger, you're going, oh man, I wish I had that. But someday you will. And so what we're sitting at is partway through the year, you pass somehow. You're the second spouse. So CRA says, oh, $300,000 in your RIF account or your RSP account, that's your income. It's added to whatever else you have made. Wow. So all of a sudden, $300,000, that's a lot of income. We're automatically at a 50% tax rate. Yeah. And before they passed, the client had no idea that this is CRA's at the table. Yeah. So basically what that would say is we owe tax on $300,000 of income. We at a 50% tax bracket, there's $150,000 that's going to CRA, and we didn't even know about that. And now we've only talked about the RIF. So we have not talked about potentially a family cottage. So we'll talk about that, or potentially an even bigger one is that business. So why did I write this is a big deal, right? There's hundreds of thousands of dollars worth of tax liability driving around in cars right now. So drive really careful. And if you're a business owner, it could be millions. Yeah. Pay attention.
So I want to back up and kind of highlight one thing, because I love the example, right? So the other part, if you think about this, so what would happen if Reb had already passed away, I now pass away, and my will might say something like, okay, well then we're dividing, we have 2 kids, we're dividing those assets 50-50. Yep. Right? And that would be, a lot of people would say, yeah, that's kind of simple will, sure, 50-50. So you would think 300,000, okay, I'm going to divide, and each kid's going to get 150,000.
Yes.
But you're saying that each is going to get 75 because 150 is going to the CRA.
Yeah.
Give or take.
You're right.
I mean, it's
so I was just going to make the point that there's now 3 people at the table, right? There's CRA, and then there's the 2 kids, and guess who gets paid first?
Yes.
CRA gets paid first. And so, again, from a planning standpoint, you go, wait a minute. How did they get to the table?
Who invited them? You are not invited to our table. And they go, we don't care. We don't care what you think.
Have you ever witnessed that surprise take place for people? Or because of your work, you're kind of preparing folks for that?
Yeah, so fortunately, this is one of the first conversations we have in our planning work. But I've heard of it third party, where all of a sudden they're dealing with their estate and the kids are going, if we'd known this, my concern is, you decide what you want to do with your estate, but to not even know this is going to happen. So I'll just hitchhike on that for a moment, because there's 2 aspects to this. There's the aspect of crunch the numbers. Have your financial person do that for you, so you're aware of the liability. But there's a hard issue here too. So what we always say to our clients is, you need to discern how much tax you want your estate to pay. That's between you and your Heavenly Father, because you're the steward, the manager of the resources He's given you. We can take that as low as 0, but you may feel in your heart that you should pay some to the government of Canada because you've lived here and we've benefited from that.
And
that's the client decision.
You've seen clients do that.
Certainly,
right?
yeah. And so all we say is, while you're alive, you need to understand how much liability is there, how much Revenue Canada is going to get. Are you comfortable with that? Most people say at the 50% tax bracket, that's not where I'm comfortable. We have other options, and we'll talk about the solutions. And often clients go, we like the solution for a tax purpose reason, but also for other reasons as well.
Okay.
So we want to do that, but I want them making the choice. Because if we are still alive, we get to choose the amount that goes in different places. And as a steward, it's really our responsibility. So let's not be unaware of this. And again, the reason for the question and the reason for the blog.
Yeah, that is, it's, I think when we learned about it, I think it was shocking. Like I just, you think about
how to get your kids to come to heaven with you sooner. Just don't make a plan. They'll look at that.
Yeah,
they will have a heart attack right there and then, and you'll see them sooner. No, please don't follow that financial advice.
Yeah, that's a little like, I don't know. I don't think, don't do what Dave says on that one.
So just before we move on,
Yes.
and sorry to cut you off, Reb,
Yes.
but I want to talk about liquidity,
Yes.
because that's another really important aspect to this. So we talked about the RIF. The thing about the RIF, it's in some kind of investment. So it's going to get liquidated, and you've got $300,000 worth of cash.
Yeah.
So if CRA wants whatever they want, you can cut the check because the asset's there. It's
Right.
what we would call liquid. It's accessible. But let's take a look at the family cottage, because that's something that often comes into play here. The way we're going to talk about something called capital gain, and just keep it really simple. It looks at the increase from what you paid for something to what it's worth when you sell it, and hopefully it's worth more. Cottage is a great example.
Yeah.
So let's assume that you've had the cottage for 30 years. We're going to assume you paid $100,000 for that cottage. And over time, you've done some additions and stuff like that. And let's say you've put another 100 into it. So Revenue Canada will look at that and say, well, your cost on that cottage is $200. Let's say it's worth $600,000 when you pass. Well, you may not have sold it when you pass, but Revenue Canada assumes that you did. So they look at the cost of $200. They go, market value is $600. There's $400,000 of profit or gain, or we would call it a capital gain. Your accountant would call it a capital gain. That means half of that right now is taxable. So there's tax on another $200,000 worth of income. We're adding that to the $300 in this example. So now we got $500,000 worth of tax liability. So unlike the RIF example, the cottage isn't liquid. Let's say that your family, that was really important to them, and you've left it to your kids in your will. Then that's great, but CRA still has their hand out for the tax.
Right.
So you need to make sure that there's enough liquid assets in the RIF, or your house is being sold and you can use that to pay the tax bill, or you've put life insurance in place to look after the tax bill. So liquidity would be the second thing to consider for clients once they know how much the tax bill is going to be.
So you're telling me that I don't have to sell the cottage to get it taxed. It's just because it exists
Exactly.
that
And
I would be taxed on that
because
gain.
essentially, if I'm understanding right, we've passed away. We come off title. We're no longer owners of it, right? And so then it gets passed to other kids or however that the will does that. But CRA looks at that and says, you sold it, right?
The day you die, everything's sold.
Yeah.
Everything that you own, the day you die, has been sold. It's been liquidated, and any proceeds from that are taxable, the tax is due.
Do you, and this is something when we talked before the show, I never asked you, but in my head now I'm thinking, like, has this always been?
Yeah,
Like,
yeah.
Canada has always done this.
Yeah. So, and the other thing, not to scare people, but just kind of be aware of what's on the, what's, been rumored to be coming, what Parliament's looking at is, so we talk about those capital gains, the increase from what your cost is to what it's worth, that's going to be taxed. Right now, half of it is taxed. So 50% goes in our pocket. I guess that's the good news. The bad news is 50% is taxed. What Parliament has been discussing is increasing that from 50% to 75%. Meaning if we've got $100,000 worth of taxable gain right now, if we have $100,000 worth of gain, 50% is taxed. What they're suggesting is in the future, they're going to move that up to 75%. So they're not saying it's going to happen, but we need to be aware of that. That makes this question even more important.
Mm-hmm.
Yeah.
And I'll give a little input to that, just short. Again, we've just gone through a period where a whole lot of money has been spent by the government, and the government is looking for ways to refill their,
Coffers.
we have to pay that money back.
That's where it's coming from.
And so some of that pressure, you think, oh, that'll never happen. Well, the government is trying to figure out ways that they don't have to raise taxes on a day-to-day basis, but maybe we can raise taxes in these other areas. And I'm not here, so I can't complain about it. If it's my estate,
I don't know if we're
right?
gonna. This is too soon, or you have other things to say. But like, is there any hope? What do we do? I mean, that's why you're here. We're not just dropping the bombshell.
And we only have a couple of minutes, which means you have to drop the hope for the next show, just so.
No, we're covering the solution in today's show. So how do you resolve this? And basically, people that are charitably minded have a great advantage or a potential solution. So what we're able to do is assets that we say are extra or beyond what we need, if we make charitable donations in our will, that's going to offset the tax. So basically, your tax preparer has done we call it a terminal tax return. If I was dead, what would the tax return look like? And let's assume, just for easy math, that the tax bill is $100,000. If there was enough extra money, or the client chose to say, we would rather have money go to our favorite charities than CRA, then they determine how much is going to go. So if I wanted to have zero money go to CRA, and my tax bill was $100,000, if I gave $200,000 to my favorite charities, that would offset the tax that is due, and so the estate would really be tax neutral. So that's where the client has to look at this and say, okay, who do I want at the table? If I want CRA there, how much? And how much would I have to give away to right size that? So that's a wonderful solution, because really what we say is, do you want CRA? How much do you want CRA to get some money, or do you want your favorite charities to get some money? So it does impact the rest of the estate, because you got $100,000 worth of tax, or you give away $200,000. So if I give away $200,000, CRA gets zero, but there's still less in the estate than if I just paid the tax bill of $100,000.
Right.
So we need to think through that, and it's not an all or nothing. It's not like, okay, I got to do $100,000 to CRA or $200,000 my favorite charities. We can blend that. Say we'll pay some tax and some to our favorite charities. I want clients going through the exercise so that they are in control and they are managing the tax liabilities, and they're managing their situation well. So
and throwing the kids back into that mix, right? Going, okay, so we've now recognized there's three people at the table, CRA and my two children, and that all of my estate is going to get divided somehow to that, right? Across that. Let's just keep it really simple. Sure. And then we go, well, we'll add a fourth person to the table. And yeah, they're going to steal a little bit of money, in a sense of divide a little bit of money from my kids. So they're not going to get as much. Yep. We're going to reduce our we'll call that social capital that's going to CRA, and we're going to move some of that social capital to the fourth kid at the table, which is charities, which is in a sense giving away. So now, and again, thinking about it simply, instead of, I thought I was going to divide it between two people, my kids.
Yes.
But there really are three people.
Yes.
But now I can kind of equalize and move it around so that it's split between four. And again, the numbers, as you say, need to work out and kind of say, okay, how do we divide that? Do the kids get this much and CRA gets this much and charities get this much? And you can divide that a little bit.
Yeah, and something else that I think is really important that gets missed here is often people have been generous through their whole life.
Yeah.
They have their local church, or they have ministries or other charities that do really good work, and they've been behind that, and every year they're giving to that. But often when it comes to their estate, they just don't think about that. Yeah. And here's a beautiful opportunity to say, what we did all through life, we are also going to do at our end of life. Yeah. So I may want to make a charitable donation at the end of life, regardless of the tax situation. Yeah. But we want clients to kind of look at both sides of it to say, what's the tax implication? What's the hard implication? How does this align with our values? Yeah. And as we manage the assets that our Heavenly Father has given us, what's the right distribution here? And be proactive about that. So the key is talk to the person, the professional that does your taxes, and have them give you a ballpark on what's it going to be, and then make some good choices around that in terms of your will, and actually put it in force. Because it's one thing to do the analysis. Now you got to interact with your legal professional to say, we got to change our will, because otherwise nothing happens. It'd be great intentions, but unless it's in the will, it's not going to happen.
Yeah, and this is a great time of year as we come to the end of the show, right? We're in November, right? Again, if you're a business person, you might be doing some tax planning, or you might be doing some of that. And then you go, okay, well, now I have to pull in that end of life. Maybe this year when you do your tax return normally that you do every year, you can say, hey, I want to talk about a terminal tax return. Like, again, it doesn't have to be this arduous process. Yeah. You're already collecting information. You're already doing all of that. And so you might say, yeah, let's just take that information, extrapolate it a little bit, totally. and then we can have our tax preparer or accountant or whoever, or the financial person, do a little bit of a tax planning for end of that would go along with the estate planning and incorporate into it. So, yeah. Reb, you got a minute?
Well, there's one question in Mark 12. We were talking about it at the beginning of the show, and it says, render to Caesar the things that are Caesar's in verse 17. But I looked 2 verses back, and it says, the Pharisees were asking him, shall we pay or shall we not pay? And I facetiously will say, well, you're going to pay whether you realize it or not.
That's not optional.
No.
But the amount is if you don't die before you do your planning. Do your planning. Be proactive.
So, I mean, you have to go read Mark 12, 15 to 17 and get a good chuckle in light of what we just said, but you're going to pay. And Jesus was like, well, you're going to pay. Whose face is on it? You're going to pay. So, Father, thank you so much for our discussion. Thank you that we can have laughter in the midst of some serious discussions, and that we can commit our way to you, and you will do it. And we can roll off these cares even while we do the action and the work of planning and learning about our finances and stewarding them. Thank you so much for our time today, and we just bless you, Father. Amen.
Thank you for being here, Tim. We're going to continue the conversation next week, so don't go away. Join us next week when we talk money.
Let's Talk Money is a division of More Than Enough Financial Fitness, where God is transforming hearts and bringing hope for today and freedom for tomorrow. For more information or to comment on today's show, please visit morethanenough.ca.